Chapter 16, trading accounts. You can say businesses that buy and sell goods will have a trading account. Only businesses that buy and sell. Will a service entity have a trading account? No, because they're not buying and selling goods. Only businesses that buy and sell. Okay, second bullet. Sales and cost of sales are important because that's looking at the trading accounts. Okay, I see they talk quite a lot about disclosure here, so we need to put a note. I see they still use the old name, which is fine, but obviously it's called something different in the real world. But the bullet to say the income statement will record the trading activities. So the trading account is actually part of the income statement because you have sales and cost of sales in the income statement. Okay, so the income statement will record the trading activities. Right, so trading activities could be buying and selling goods. It could be paying for rent, paying for electricity, paying for all the other operational expenses. Okay. All right, so we've covered that. You've covered that. Oh, just one other note there, just an asterisk underneath. It's a follow-on for this point. The income statement shows the profit for the year. That's what you're actually calculating. And you've seen that before. Okay, right at the end, you have one line that says profit for the year. Profit before tax, profit after tax, that type of thing. Okay, we'll see those later on when we do practical examples in the assignment. Right now, we're just summarizing what we need to get you into the theory. Okay, perfect. Okay, we've covered that. We've covered that. Oh, the difference between revenue and capital expenditure. Do you still remember? Okay, so bullets. Capital expenditure versus revenue expenditure. Two different types of expenditure. Okay, capital expenditure versus revenue expenditure.
I'll just say what it is. So capital
okay, you're going to say what it is. So capital expenditure, spending on non-current assets. Okay, so just think about long term. Underneath capital expenditure, you can even write the word long term.
Spending on non-current.
On non-current assets. Okay, so we buy land and buildings, that's capital expenditure. It's long term. Okay, then the other one, revenue expenditure. What do you think this one is? If capital is spending on long term, revenue expenses would be spending on short term, exactly. That's it. That's as easy as that. Okay, so the next one, revenue expenditure, spending. The way they describe it is on everyday expenses. Right, spending on everyday expenses. Okay, revenue expenditure, spending on everyday expenses. You can put an example there, e.g., rent, water and lights, etc. Right, so buying land and buildings, capital expenditure. Paying for water and lights, revenue expenditure. That's just theory. As I said, theory will probably be tested in the assignment, probably not in the exam. Okay, we'll have to look at past papers to make sure. Okay. What did you say? Oh, short term, example, water and lights. Okay. All right. Then you get okay, sales, purchases. This is all looking at the trading account. Okay, so this you're going to have to draw up. Let's see how they've shown it. Okay, they've shown it in a disclosure format, which is fine. So then you don't have to worry about the T account, which kind of helps in a way. Right. So underneath this, you can say formats. And then we can do a trading account. Right, so we've discussed the theory. We've just got some practical examples now.
Okay.
Right, so heading, format. Maybe just be specific because there's quite a few things there. Just say, because there's a few formats that we need to look at. The first is the trading account. So format for the trading account. That's the first one. Okay, so earlier we explained what the format is dealing with. Trading account means we're buying and selling goods. Right, so the format for the trading account is going to highlight all the line items that relate to sales and cost of sales. Right, so underneath this, you're going to have to write down trading account for the year end. Okay, you don't have to do that. Maybe let's just put a column at the end so you can put the totals. That's fine because you've already put a heading for it, so that's not a problem.
Okay, so
just a column at the end.
1.
Yeah. Maybe let's use double columns because it looks neater. Okay, perfect. Right, so what's the first line going to be if you're trading?
Sales.
Sales, perfect. Okay, there's line number 1.
Is that an account that is not a tier account?
Yes. You've seen a tier account before, but here they've done it in line, horizontal, laid out format. Okay, so I'm just sticking to what they've got there. Okay, so sales, the first line item. What is the sale going to be? What's the next line after the sale? Good. Okay, cost of sales. Right, do you agree cost of sales will have a working? Okay, and that would be separate. So underneath cost of sales, indent it. So leave like a little gap because it's a separate calculation.
Like a line.
Not a line, but like this. So you've got sales and you've got cost of sales. Okay, then just put opening stock. Okay, purchases like that.
Yeah.
So leave space there, indent it. Okay, so the first one, opening stock. Next line, write the word add purchases. Add purchases. Because that's the formula. This is looking at periodic. So I'm trying to integrate things with what we've covered before. Okay, add purchases, less purchases returns. Less purchases returns. Add other purchase expenses. Like carriage on sales, not carriage on sales, carriage on purchases. Custom duties, all those other things we saw in the inventory chapter. Okay, and then the last line, less closing stock. Less closing stock.
Okay.
Big total.
Is that all?
Yeah, that's all.
Okay.
Big total, gross profits. That's the last bit. Yeah, so big total, gross profits. Because sales minus cost of sales gives us the gross profits.
Total.
Gross profits. Got that? Yes, perfect. Okay, so let's just put in some figures just to make this make sense. Okay, let's make sales 100. Other column. Yeah, the end column. Sales, because sales are total already.
Yeah.
Sales 100. Okay, the cost of sales we need a working. So opening stock, make opening stock 50. Add purchases 10. Less returns 5. Add other purchases expense, make it 15. Less closing stock, maybe 20. Okay, so now we need to do some arithmetic. Opening stock 50 plus 10 is 60. 60 minus 5, 55. 55, no, plus 15.
Oh, sorry, plus.
Yeah, 55 plus 15 is 70.
Okay.
70 minus 20 is 50. Okay, so cost sales is 50. Great. So what is the gross profit? No.
No, minus.
Be careful. Expenses are shown in bracket. There we go. That's disclosure. No?
50.
50, good. Okay, nice. There we go. There's the example. Alright, chapter 16 just ends with two, how many? 1, 2, 1, 2, 3, 4 short little considerations. Okay.
Chapter?
It's still chapter 16. Let's just carry on where we left off. Okay, just put a heading, other considerations.
Okay, I'll just make the notes. It doesn't.
Well, they're separate, but it relates to that.
Yeah, I'll make it as a heading.
Oh, it's a heading.
Yeah.
Okay, so number 1, treatment of inventory. Underneath this, you can say, see detailed periodic versus perpetual.
Okay, so treatment of inventory.
Inventory, yeah. So the bullet underneath this, see periodic versus perpetual, or see periodic / perpetual. So you have to refer to your other chapter to understand what periodic and perpetual is, to understand this. Okay, but the importance here is the disclosure and how we show the profit. Okay, because that's what we're trying to calculate, the trading accounts. Okay, so just refer to your perpetual and periodic. Okay. Right, then we need to highlight what they've said here. So in the textbook, they talk about the treatment of inventory. Is inventory just inventory?
Yeah.
No. Inventory can be different forms of inventory. Doesn't make sense. So if I'm manufacturing goods, I can have raw materials. Is raw materials inventory? Yes. Can I have a work in progress? Yes. Can I have a finished product? Yes, all of that's inventory. Okay, so that's what they're discussing here. And the most important one that they've given you here in the textbook is opening and closing inventory. There's a difference between the two. Okay, so that's what we need to differentiate. So underneath this, just states inventory can be categorized. Categorized meaning I can put it into a group on its own. Right, inventory can have opening or closing. Inventory can have raw materials and other. Okay. Right. The one that's important is the opening stock, closing stock thing.
Yeah.
Right. Okay, so you've got that. Okay, so next line. Opening inventory is at the beginning of the year. Closing inventory is at the end. Why do we need those two? Because we need to do a calculation for cost of sales. That's the important bit. Yeah, so opening stock at the beginning, closing stock at the end. We need both to calculate cost of sales. Okay, just underneath that, just say NB, periodic. Periodic requires a cost of sale calculation. And then they've even given you the formula here as well. Okay. The formula here is very simple compared to the one that we've seen before. Yeah, periodic requires a cost of sale calculation.
Okay.
Right, then you need to write down a formula. You can just say cost of sales formula, and then let's write it down.
Yeah. Oh no, because I've got this equals. So.
Okay, that's fine. So what is cost of sales? Opening stock. Just write it as one line. Opening stock plus purchases minus closing inventory. That's what they've given you in the textbook. We know that that's not the only thing that we take into consideration.
Opening stock plus purchases
minus closing inventory. Okay, so that's what they've described here, but obviously that working is slightly longer because of the periodic system later on. Okay, so just bear that in mind, because remember, we jumped around.
Yeah.
Okay, we covered a chapter later, and then we're going back to these. We're just staying in line with the work program. Right, but we've already seen the more advanced equation. Okay, that's the first thing. The second thing, this one's actually short. Valuation of inventory, that's the next bullet. So you've got one. Number two. See, again, we've already looked at this. We spoke about cost and net realizable value. Remember that? See, they're describing it now because this is chapter 16. Mm-hmm. But in terms of the chapters, we already looked at the inventory one. So we're just referencing what we've already looked at.
Okay, so
number two. Number 2, valuation of inventory. Okay, first bullet. Yeah, I think let's just finish 16 and we can carry on to 17 next time. Okay, because it is going to get a bit much. And there's still 2 more little points here that we need to cover. Okay, and we're done. We've done well today. We did a lot, eh? Sure. A lot of small little chapters. Okay. Alright, so first bullet. Again, refer to that later chapter. So say C periodic / perpetual, because the detail is there. And then we're just going to write down the summarized concepts that they've described here in chapter 16. Okay. Right, C periodic and perpetual. Okay, the most important thing is inventory is measured at the lower of cost and net realizable value. That's the most important concept to come across. Why? Because you can only value something at what it's actually worth before you sell it. Let's just repeat. Inventory is measured at the lower of cost price and net realizable value. Lower of cost price and net realizable value. Right, I'll just read a bit more in terms of what they said in the paragraph. They say this is the overriding principle and must be used. At a later stage, we will consider the implications of this rule. We've already looked at that already, okay? Because we looked at this.
What does this mean? Inventory is measured at the lower of cost price and net realizable value.
Okay, so if I buy, so let's say I buy a bottle of water.
Yeah.
Okay, that bottle of water has a cost price. Let's say that cost price is 10 Rand. Okay, if the bottle of water when I buy it costs 10 Rand, that's the cost price. But now I've kept the bottle of water in the store and now the bottle of water has expired. Right, do you think that bottle of water is still going to cost 10 Rand? No. No one will probably want to buy that bottle of water. So now the net realizable value will be what it's actually worth. So now the bottle no one can drink the bottle because the water has expired, but now the bottle itself can be recycled. So we can say now the bottle of water has a net realizable value of 1 Rand. Okay, so now if I'm accounting for inventory, do I measure the stock at 10 Rand or do I measure the stock at 1 Rand? I measure it at the lower of cost and net realizable value. Okay, so the bottle of water is actually worth 1 Rand to the business today. I can't record it at 10 Rand, even though I bought it for 10 Rand. Does that make sense?
Yeah.
Okay, that's what they're trying to say. Okay. All right, number 3, treatment of returned goods. That's the third one. Almost there, okay. Treatment of returned goods. Can you have a purchase return and a sales return?
Yeah.
Yes, you can. Right, so the first one, maybe you can label this A. Sales returns. Who's returning if the sales return? Us or the customer?
Sales return, the customer.
The customer, there you go. Okay, so first return is a sales return. Okay, they didn't give you a bolded word or definition here. We'll describe it now. Okay, so number A, sales returns. Customers returning the goods that they buy or the goods that they bought. Okay, past tense. Customers returning goods that they've bought. What is that going to do to our books? Will that reduce the sales? Yes, it will. Okay, so sales returns, customers returning goods bought. Go back to this, okay? Next to sales, open a bracket. And then just write it like this. So you've got one line. Okay, just write it small. Sales minus sales returns. Again, how much did we say there? 100. Then sales, make it 110, and then say minus 10. Does it make sense? Okay, so just to add to your format, so you've got everything. Right, so just a small little formula. Sales minus sales returns. And then put an amount. Put 110 minus 10, close the brackets. Okay, so what is that showing you? That's showing you that I sold 110, but some customers came back and returned the goods they bought. Does it make sense? Okay, that's what we're dealing with here. Makes sense? Okay, the last bullet there is B. Number B. Yeah, sales decrease. Perfect, yeah. B, purchases returns, comma. We return goods to our supplier. That's a purchase return.
We return
goods to our supplier. Okay, so what is that going to do to our purchases? Exactly. So next to that in brackets, like what you did previously, you can say arrow down purchases. Right, and did we show that here? Yes, we did. See?
Yeah.
Less returns. Okay, good. Right, and then the last thing here is just treatment of expense incurred in the carriage of goods. So just an asterisk or let's label it number 4 because you've got it 1, 2, 3, 4. The last bit is just you can just call it carriage on goods. Treatment of carriage on goods. Okay, there's 2 separate ones. Okay, so again 2 bullets. Carriage on goods. Okay, so first bullet, they use these fancy words, carriage inwards, carriage outwards. That's what they use, and that's what you'll probably see. So the first one, carriage inwards. What does that mean? I'll read the definition here next to the paragraph. An expense incurred when a supplier charges for delivery on the goods purchased. So what would that be seen as? Carried on purchases, basically. It's just a different word for it. So you can just say expense on goods bought. Right, so when we buy goods, we need to pay for the delivery. That's what you're looking at there. Right, and then the second bullet, the last bullet, carriage outwards. Carriage outwards, I see in the textbook they even have another bold word here. They said carriage on sale. So you can say carriage inwards / or comma is the carriage on sales. That's what it is. To read the definition, an expense which the business incurs when it pays delivery for goods to the customer.
Was this carriage inwards? What was reading about?
Carriage inwards is carriage on purchases. Okay. Carriage outwards is carriage on sales. Yes, that's right. Okay, if you want to write something next to it, expense on delivery to the customer. Right, so the one you pay for goods coming into the business from your supplier, this one you're paying for the goods going out to the customer. Does that make sense? Yeah. Okay, perfect. Right, and that covers that chapter. Well done. 16.